Hi there, it's Ron Gula from Gula Tech Adventures. Today we're going to talk about common myths that I've encountered from people who raise money from venture capital institutions. Now, I got my start in cybersecurity working at the national agency, brought a wide variety of companies to market, including being the co-founder and CEO for Tenable Network Security, which is now a publicly traded on the NASDAQ. I'm the president of Gula Tech Adventures. We've invested in about 30 or 40 different cybersecurity companies, so we've had a bunch of exits. Throughout my career, I've been involved with over several $billion worth of investing with exits and capital creation in the cyber market. But what I'm going to talk about is really generic to all types of businesses. Anybody who's trying to raise money or watch perhaps too many episodes of Silicon Valley on TV. So I've encountered a lot of myths from founders about how they perceive working with and what their lives are like after they raise venture capital. And I've got 4 very simple myths I'm going to talk about today. 1, you might not need to raise. 2, you might not have to sell your company. 3, you really don't lose control when you raise. And 4, you don't need to do an amazingly, big, huge round. And when I say this, I've said this a lot in public speaking. I've said this a lot to the media. And I always kind of get a lot of raised eyebrows. So, when I tell people you don't have to raise money to create a great company, they kind of look at me a little odd. Now, I'm not saying that you have to work and eat ramen noodles and sleep on your friend's couch when you start a company, but one of the things I like to do with startups is talk about their origin story. Why did they start? How did they get going? What did they need? And a lot of companies get up and going without raising 1 cent of what I call professional venture capital. My wife and I, we've done this. We created a company called Network Security Wizards. I was able to write the product, and we were able to hire a few people, sell the product, and basically be cash flow positive more or less from the start. And once you're in that sort of cash flow positive, the relationship you really have to worry about is between you and your customers, between you and your employees. And that is such a beautiful thing because it really allows you to focus on what the customer's needs and maybe not what investors, what their needs are, which are usually aligned, but not necessarily always. Now, if you're researching, hydrogen fusion, if you're researching, amazingly, trying to cure some diseases, you probably need capital. You probably do need partners to do it. But in IT, in video games, in cybersecurity, it's pretty easy to bring a product to market if you've got the right sort of know-how to how to build that. So you don't have to raise venture capital. Now, the second thing that I talk to a lot of founders about is they all believe that the only way they can possibly do anything for their employees, for their families, or for themselves, as far as creating equity, is to sell the company. And this, of course, is all roads lead to Rome. And when I talk to so many founders, it's like no matter what their path is, they eventually want to sell the company. And I'm going to tell you that if you got in business to cure diseases, or in my case, do cybersecurity stuff, your goal is really focusing on solving that problem and not necessarily just to make money. And this is something I've encountered with many, many founders. Now, granted, when you start a company and the company's valuable, you have to handle equity creation. You have to kind of think about what's best for your employees. And if you really, do it well, you have to really think about what to do with that kind of wealth that you're created and what kind of person you want to be post-exit. But you don't have to exit. You can do a lot of things. Along the way, you might be able to sell parts of your company directly to investors who just want to buy those shares. When I was running Tenable, we did this twice. A lot of those big rounds that we did were not investments that go on the balance sheet. They were literally purchases directly to those employees. And I've encountered many, many different types of businesses where the founders and their employees were able to sell shares along the way. And that can be very meaningful to an employee who it may not be able to wait around for an IPO. Second thing you could do is if you have a profitable company, you can share those profits. You can give yourself a large salary. You can give your employees great bonuses. You can actually return a lot of the profits that your company is making directly to your employees. Now, it's not the most tax efficient thing, and this could be qualified as somewhat of a lifestyle business, but it's your company and it's your life. And I've seen many companies out there do this and really take care of their employees over the years, as well as just focus on their customers. Now, you can also spin things out. Let's say you're a great donut vendor. You're making the best donuts in the world. And one day somebody comes in with an idea to sell croissants. Maybe you don't want to be in that business, but you can spin out that croissant business. I've seen many services companies spin out IT product businesses. I've seen many pharmaceutical companies do spin outs like this. It's a great way to sell that off, let somebody else run with it, and you can get a return on that type of stuff. And then lastly, you can also say, you know what, I'm not going to aspire to actually take my company and work for somebody else. I'm going to go public. I'm going to take this thing to the next level. Now, you're talking about the upper 1% of 1% that's out there. And today, of course, recording this in late 2022, we've got the notion of special purpose acquisition companies where companies go on the public market and then they're bought, and it's not the traditional IPO that you might see on TV or what Tenable went through, but it is absolutely an option, and it happens quite a bit in our industry. Now, the third myth is that when you raise money from a professional venture capital fund or even a sophisticated individual investor, you're working for that person. And of course, I'm saying, look at me, I'm the captain now, look at me, I'm the CEO now. But the reality is, a lot of times, if you have a founder who's a first-time CEO, and he or she is used to being like the end all, the buck stops here, really what they're talking about is they're not used to being transparent to a board or potential investors. Usually, if you're the CEO, you're the king, you're the queen, you're the person in charge, and you might be a benevolent leader and people might love you, but the final decisions stop with you. As soon as you start raising professional money from someplace else, you kind of get to have a conversation. What is your plan for next year? Maybe the investors say, I'm willing to invest in you, but I want some rights, such perhaps control a budget, perhaps a right of refusal on new investment or even acquisitions. Now, a lot of CEOs and founders, they might look at this and say, wow, that's way too much control. I don't want to do that. That's great. Go get a loan, go make more money from your customers, find a great way to save money in your business. But people who do investing into companies, they bring with them sort of either a long or even a recent knowledge of all the other companies that they're investing in. They have a lot more to offer than just sort of being annoying or requesting more meetings and calls to explain, why we lost this deal or, why a competitor is winning and so on. Another way to think about this is, let's assume you're the world's best CEO and you're on your way to creating a billion-dollar, if not multi-billion-dollar company, and you own 80% of that company. What happens if you get hit by a bus? What happens if you go through a divorce? What happens if you get sick? You're a single point of failure. And one of the things that I talk about with people who are kind of lamenting about bringing on a new board member or a new investor who's going to have certain amount of control on their business is that what you're really talking about is you need to let go. You're creating this business. This business is going to thrive without you if you guide it and you enable the people not only who work for you, but if you can kind of create a board that's going to help guide that company. And if you look at it like that, it's a little bit different. But some of my CEOs I work with and I've worked with in the past, they definitely are it's a transform that we have to all work together and work with. Now, the last myth I want to talk about is I see this a lot. You're here, you're working, maybe you're the best, like I said, you're the best donut maker in the space, but then all of a sudden a donut maker across the city, they raise $100 million. And it just looks like, holy cow, they've got their act together. They've now got $100 million to come after you. And this happens all the time in the cybersecurity space. It happens a lot in the pharmaceutical space. Why? Because there's a lot of money out there. There's a lot of money out there that's waiting to be invested. And maybe you're a pioneer. Maybe you're the first person who invented the donut. Well, if you're the first person who invented the donut, even if you patent it and own donuts, people are going to find ways to make sugary, floury things for breakfast and compete with you. So usually it's not a bad sign that the other companies in your space are raising money. It's very indicative that there's a market for this and customers want to buy your product. Now, from a founder's point of view, though, would you rather be the CEO who owns 40% of a company gets acquired for $30 million or 4% of a company that gets acquired for $300 million? Now, those two numbers, if you do the math right, I think it comes out fairly simple, but guess what? You can probably create a company, bring it to market, and get the revenue to go with that sort of valuation a lot easier than doing multiple rounds and trying to get to that big exit. So a lot of times I see organizations, they are looking at the other guy, the other company who's raised a whole bunch of money, and then they're like, oh, I want to be like that. Well, remember what I just talked about before about losing control, about not having a lot of transparency. If you're not ready for that, you're not ready to raise that big number. Now, there are a couple negatives along with this. Usually when somebody comes in and they make a bet on a company, good for them. The investors there, they believe in the team, they believe in their go-to-market, they believe in the market overall. But that company has to now work a lot harder to get the revenue to be commensurate with that market valuation. This happens all the time in cyber, where you might have 4 or 5 companies doing $1 million to $5 million in revenue, and they're all worth anywhere from maybe $10 million to $50 million on paper. And all of a sudden, a major investor comes along, picks one of those, and sort of anoints it as the winner, and says, "We're going to put $100 million in that space." Just giving money to a company doesn't make customers spend money with that. They have to put that to work. It's actually a lot harder in some cases getting to where they got in the first place. So if you're on the vendor side and you see these big rounds, might be a really good indication that that's a winner, but it's not necessarily always the case. You need to evaluate those products and see what they're doing. So once again, the 4 myths I was trying to dispel is that 1, you don't have to raise. You don't really even have to sell. You don't really lose control. And then when you do see somebody who raised a whole bunch of money, it's not necessarily, a slam dunk deal if that market's over. All right, if you enjoyed this video, please subscribe to our other videos here on YouTube. We talk a lot about cybersecurity and starting businesses. You can always visit us at gula.tech. Once again, I'm Ron Gula. Feel free to chat me up on LinkedIn. Have a great day.